everyone who chooses to tune in. Oh, okay. Seeing lots of different things here that I don't normally see. That's interesting. All right, guys, I believe we are live. Thank you, Sam. Much appreciated. I did get that message, and here we are. Welcome, everyone, to Thursday's edition of Trading Buddies. It's great to have you on board, as always, and hopefully we can get a little bit of action going on as far as ticking some money into the till is concerned. That would be nice. Righto, let's get stuck in, shall we? And I will firstly go to pound versus the US dollar. We could do with the winner on that one too, I can tell you. That's not it's not going so good at the moment. Things come to those who wait, is what they tell me. Seeing an incredible screen that I don't want to see here. Guys, can you see my screen? My pound versus the dollar screen? If you could let me know that, that would be good. Yes, you can. Awesome. Thanks, Sam. All right, I think we're in shape. I'm seeing YouTube, and that doesn't normally come up on my screen. But there you go. Righto, what are we doing? We've got a decent range. Look at the candles, guys. If you were trading pound versus the dollar yesterday, you had a ride and a half, did you not? I can close YouTube. Thank you, Sam. Done. And now I'm going to get my control panel back. All right. Yeah, it was a ride and a half yesterday. Well, early this morning for me, whilst I slept. And I actually had an order short euro dollar that I cancelled before I went to bed. I'll have a look at it. I haven't even checked. Been really busy today. I haven't even checked how that would have turned out. But by the look of this, it may have been a wild ride. Well, obviously it went up before it went down, so maybe I didn't get triggered into that till later. Might have been a good trade, the breakout trade. What am I doing? We've got a range thus far with a couple of minutes to go of 113.28 to 114.22. So what's that? 94 pips of risk, of range, and that gives us 47 pips of risk. So, yeah, well, there's nothing wrong with the position. Definitely not. Daily pivot test, untested. I actually don't mind this today. And the reason I don't mind this is what we've had from the Fed overnight, of course, is what's caused this this big movement. And I'm sure Ash will have a couple of words to say about that a little bit later. But what my idea running through that is that a gut reaction is often, I won't even say reversed, but it's responded to. And I'm of the opinion that long here today would be the way to go. I'm not saying all the way, but retest the breakout area. As always, that's what we're looking for. But let's see how that goes if it sets up on things like the euro, things like the Aussie, things like the Kiwi, even things like the pound. So the order is going to be long at 1.1375 with a stop loss at 1.1328. I might as well put that in there. Now, again, if you're joining us for the first time, this is very much a trial, and we cannot say to you in any way, shape, or form that this is reliable. So please, if you are looking to trade this, trade it at very, 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 very small risk. Righto, we're going long, 113.75. And we have a stop loss of 113.28. And we'll, what's that? We'll say 47. What's 47 times 2.5, guys? 94 plus, let's say 13. So 107. We'll put that as 107. That'll be our take profit. And TP1. will be at 114.22. We will close nothing at that point, and we'll move our stops to entry. TP2 disabled, buy. Right, yeah, there's our target, just underneath the weekly pivot. I wouldn't be disappointed with that position. That makes perfect sense to me. And when it makes sense, I'm happy to go there. I'm not, however, unless I saw a setup, happy to trade that per se as a, let's call it a regular trader. All right, so that's the pound. Updates. What have I got to update? Euro Aussie. Placed an order Euro Aussie yesterday on this bar. As you can see, it expired. Got pretty much a replica of that bar. So I placed the order yesterday on Monday's bar, Tuesday's bar, and didn't get triggered yesterday. Very much a replica of that Tuesday's candle was printed yesterday, and I chose not to trade that. Why? Well, I just had a little feeling in my bones that a tweezer bottom, look, and really, you know, if you see this down here, double rejection of a monthly pivot with a weekly pivot untested above you, you'd be jumping, or I'd be jumping all over it, let me put it that way. But it's not down here, it's up here. Yes, it's probably, or potentially, or could be, or probably is a bull flag, which means that we're going to get a bounce here and test the highs. I'm not really of that opinion. We've got a double top. We're looking for a lower high. And I think the weekly pivot can produce that lower high. And as always, I like to see a rally before I see the lower high. Maybe that's it. And really, I didn't see much reward to risk available to take that position on Euro Aussie. So I didn't replace the order. And that is now not off my watch list, because I'd like to trade it short if we do pick up that lower high up here somewhere. What did I trade this morning? Euro CAD, which has been triggered. This is problematic at this level on an hourly chart because we're right at the bottom. But on the daily chart, exactly the same scenario. If I look at Euro Aussie, right, tails to the bottom side, suggesting long. If I look at Euro CAD, tails to the upside, suggesting short. So I'd much rather play this, and I've got to say I'd much prefer this to be off the weekly pivot, to be fair. But I'd much rather play this from the highs short than I would from near the highs long, if that makes sense. So I'll just point that out again. We're near the highs here, looking for that tweezer bottom going long. But as I said, tweezer bottoms belong down here, in my humble opinion. But Euro CAD, I've got tweezer tops suggesting short. Yes, I'd prefer them up here, but I'm willing to take the risk on them down here. So at the moment, that looks reasonable. We'll see how London deals with that, with the euro weakness. If it comes back in, happy days. If it doesn't, euro dollar, that was the order I placed yesterday, was under here with my stop loss above here. I think I might have been okay with that because I think it rallied before it went short on the back of the Fed statement. So one that got away, maybe. Like I said, I wasn't that super confident that we had a big enough candle, to be fair. And really what I like to trade when I'm trading the FOMC breakout is the range of the 3 days prior to the breakout. So there's 1, 2, 3. So the range was a little bit higher than I was prepared to take. Mistake, well, you know, trading breakouts at the end of the day, it was a setup as well, in that we had price come back underneath not the trade line, which of course is the top of the range, but this horizontal level. So it was actually a false break of a horizontal level. And this trade line through here, if I can point that out to you, it might make sense. So no Fed, I absolutely stay in that position. There's the entry, there's the stop loss, and that would be now at take profit level, pretty much. The interesting part about this is that I don't think that this goes too far, too much further short until we get a pullback. And that's what I'm expecting today, frankly, on not just the euro, but anything against the dollar. Unless there's massive follow through, I'm expecting not even consolidation, I'm expecting pullback, because the gut reaction that we got from the Fed, I think, and I haven't read the statement, and Ash will pull me into that knowledge very, very shortly, I'm sure. But from where I sit, this has reached a support level, and the gut reaction that we got from the Fed may well not be reversed, but be recalculated. Let me put it that way. So the market might have and seriously, we're now into a UK session. They haven't even had a crack at it. So they're now considering what that Fed statement means, what position they're going to take based on that. So I'm suggesting that long is the way to go here on a very short-term basis. And if I can trade euro dollar long today, I most certainly will. And I've got an untested daily pivot with a monthly pivot sitting there as well, exactly the same level. We're at a support level, that trade line that I showed you. And I'm looking for longs here on euro dollar today, just to the daily pivot, no more than that. What happens after there, I don't really care. It's also the breakout level from the news yesterday. So that's where I'm sitting on euro dollar. What else did I have this morning? I had a couple of things. I'm still keen the Kiwi for the week. Those of you who are in on Monday, trades of the week were euro Kiwi short and pound Kiwi short. They played out to a degree, and if you got into that, happy days. I hope you did. I didn't, because I didn't have it set up. Maybe that one there would have worked from Friday's bar, but I'm looking for a pullback here. So any pullback on pretty much 4 hour plus time frames, I'd be happy to trade short. Don't want to trade short here. In fact, a big pullback would be handy. Well, let's see if that's possible. On euro Kiwi, pound Kiwi, still struggling with that horizontal level. I'd like to see a bull bar here. Today's bar, it doesn't look promising at the moment. It's like it wants to carry on, but a bull bar here on the daily shows you that the head and shoulders neckline, I was going to say has been breached, but really it hasn't. If I look at that closely, it's really closed on the neckline, hasn't it? So this is a bit tricky, a little bit tricky. Maybe I do need a close down here, then the pullback to get into this short. That's pound Kiwi. So still watching those like a euro Kiwi, pound Kiwi. If I can get away into them, happy days. Now, what did we trade? I think we left you with two trades on Monday. One was Aussie 200 long. Thank goodness that hit. Well, actually, it wasn't target at the time, but when I had a longer think about this, I took full profit at this level here, which was just around about the 7,000 mark. So we got the Aussie, but we missed the S&P 500. Just didn't have my entry high enough for this one. And of course, it's capitulated ever since. Not that I wasn't expecting that, but I was expecting it up here. I wasn't expecting it down here. What happens next? Great question. After the Fed, I'll have a talk to Ash about that in a minute. So one up, one down. Disappointing, you know. I think it's a volatile market, and if it gets square, you're probably doing okay. However, and I'll bring him in now, Ash very, very, very nicely picked the NASDAQ short on Monday, and if you look at this chart, it's gone straight from resistance to support. and what happens next. I think he's got that little inverted head and shoulders now. Maybe we can look for a long today on the NASDAQ. That's kind of what I'm thinking. Smaller time frames, you could probably even trade it up to the pivots if there's a setup. I don't know that I traded the NASDAQ ever on a small time frame. I need some advice from Ash on that one as well. But if it reacts like the euro versus the dollar, I've got a little bit of a double bottom. I've probably got even a higher low here. I just need a candle pattern that suggests that I can trade it up to here, maybe even up to the monthly pivot. Don't know if I want to go any further than that, but that's kind of what I'm thinking on that one. Interesting, gold and silver. If gold's going to put in a higher low, it better hurry up, because it's just about to take out this double bottom here. Wow. There's going to be a really, really good price on gold one day, but I don't know where it is. Well, I keep telling you it's down around the 1200 mark, and there's just nothing on this chart to suggest that's not the case. Still down here, it's still going strong, and this level appears to be next to me. Silver, I thought silver was a buy last week, as we said, and this week it's come straight back, and we're pretty much exactly where we took off from the week before. So what happens next with silver? Well, I've still got this channel. I'm still waiting for a higher low. That's the one that we picked last week, and we said would be a decent buy, and that turned out to be the case. Now coming back, I think another higher low here off this called a triple bottom, but it's a triple bounce. I'd still be willing to trade silver long. Look, seriously, if I'm 100% honest with myself, I'm saying I really can't pick the sentiment of this market right now. It changes day to day, and of course we've had a big statement from the Fed yesterday. I think that's probably put a different, well, and why, I don't know. The only speculation going into the Fed meeting was, is it going to be half or is it going to be 3/4? Bring in Ash. G'day, mate.
Hi, mate.
What did they say?
Well, they did obviously go 3/4. I think the main takeaway, and while the market is managing to get somewhat stable today, is the speculation really, through this the financial system that this might be the last aggressive hike. But that's not really what Jerome Powell said. So I think the market might still be a little bit early about thinking that there could be some buying. I think you're absolutely right on silver. I think that it does push down a little bit further. I think gold's got a chance as well. I'm going to show you something about the FOMC though, which I found quite interesting yesterday when I was kind of looking at the FOMC and what tends to be the reaction, and see if we can surmise why the reaction might be the way it is. This is the NASDAQ, and this is the day that the FOMC announced its rate decision. So on the first one, it was a green day. That was back in on the 26th of January. A green day followed by a rally. Another green day followed by a rally. A green day followed by a fall. A green day followed by a rally, a really good rally actually. A red day followed by a fall. Now this was yesterday's bar here, so it's a red day. So it suggests that if you look at sort of there's obviously not that many, but this is really the interesting thing is that the most recent runs here have been red. So even this one was a green day, even though it was followed by a fall. Really, we're looking at 1, 2, 3, 4, 5, 6, 7 now. So 5 of the last 7 have been green. People ended up buying into the decision. And the question is, why is that? And I think it's because the market, and if you look at the dollar, generally speaking, same thing, it's often followed by a fall within a couple of days. This one really didn't go anywhere. This one was a red day straight away, and it did fall eventually. This one fell away. This one fell away. This one really boosted up, and eventually it came back to near enough where the price is. But what this is kind of suggesting to me is that the market is trying to pick a bottom. is trying to say that every single time that they've announced, they're looking at the data that's coming out, and the data is not matching. So really, it's the run between this FOMC meeting to the next FOMC meeting. That's what it suggests. It suggests that really after the FOMC meeting, the market kind of doesn't really go anywhere specific, for the next few days. This one didn't really. It ended up right back where it started eventually. This one ended up right back where it started eventually, as did this one eventually. And it didn't take that long. This one was a red day. That didn't take that long to kind of get back up again. That was a red day, and it didn't take that long to get back up again. So, the FOMC in itself doesn't provide us an ignition for a rally, for a significant rally. We see the initial reaction. There's loads of volatility, as you quite rightly say, but it's not really that kind of moves the market for over the course of the next 10 days or so. And what really does move the market over the course of the next 10 days is anticipating what the next decision is going to be. So what people are now focusing on is, what's the next set of data points? Jerome Powell effectively said, we will go with the data. What we're hoping that this is the last bumper rise, which I think is fair, but ultimately the data will be dependent. And the main takeaway that I got from him was that he said the target range that people assumed is probably higher than you think, than we initially thought. And they always get this stuff wrong. But back in January, it was transitory. It wasn't going to be a problem. We weren't going to go anywhere, which is why the market really probably sold off every time that the data kind of, when the Fed started to raise interest rates, the market sold off because they were hoping that the action would actually take some hold, but it hasn't taken any hold. The JOLTS data, so the job openings that we saw on the previous day, were really, really strong yet again. So the employment data is really, really strong. That suggests that whatever the Fed are doing is not really taking enough of a hold on this market than it needs to do. So every time the market rallies, the Nasdaq particularly suggests to me that it's a selling opportunity. So I'm toying with staying in this, or whether I should come out and wait for a move up and then get back in again. I haven't really decided yet. But the key aspect really is that the data, as it kind of starts to come out, what we really should be trying to do from here on in is assume what the next data point is going to be. What will be the next CPI print? What will be the next jobs print? And the trend is still going in one direction. So I think if the jobs data does come out weak, it's going to be a split of the trend, and that's the point that everybody starts hopping. The thing is, people will hop early in anticipation that could change, So that seems to me what people are doing. You were talking about sentiment. The sentiment to me suggests that people can't wait to buy this market. They can't wait to buy the Nasdaq. They can't wait to buy silver. Which is why we're getting these really sort of spiky rallies, because what people are hoping is, I've picked the bottom. Now all I need is the data to match the price and I'm off. But the data doesn't. The data continues to quash what the current price point was, the current bottom was. So at this stage, I would suggest that we should be still looking for shorts, as dangerous as they are. We should probably still be looking for short positions, and we saw it with the yen. The yen is exactly the same, but in reverse. As the dollar and everything else started to rally against the yen, the speculation was they've got to change. Whatever happens with Japan, they can't sustain it, but they kept sustaining it. So every time the next BOJ statement came out, they said the same thing. And it's so everybody ends up being too early, and I suppose that's the difficult thing in some respects. Is the difficult thing about firstly using technical analysis to figure out what's going to happen next over the longer term, and secondly to try and assume that, or to try and anticipate what the central bank is going to do next is very, very difficult. But if we continue to read the data, and if we go like now to the dollar, we continue to read the data and we continue to trust the data at this particular stage. And it's difficult with data because sometimes you don't know what people are looking at. You know, good news can be bad for the stock market, and bad news can be good for the stock market, and it becomes a real challenge. You know, that kind of thing. But if we consider what the FOMC appear like they're looking for, it is the jobs data and it is inflation. So looking at the jobs data, this is what we got. Now, have I got jobs data? So unemployment claims, they did creep up a little bit. Now, where's the we're in November, aren't we? So I need to get to November.
Yes, we got here fast too.
Yeah,
November.
we did. You know what? This year is starting to go very, very quickly. Unemployment claims, you know, they're pretty flat on that reading. But this was the big one. The JOLTS job openings. There's still you know, enough jobs out there for the Fed to assume that the economy is in relatively good shape. And apparently, the metric they're looking at is the job openings divided by the workable unemployed. And because that number isn't really sort of helping out, you know, when they are sort of dividing one number against the other, it's not going up, it's going down. So they've got, in a way, no other choice but to say, well, the economy's strong enough. The economy can take our interest rate hikes at this particular stage. Nothing is getting broken. And just when we thought it was getting broken, then we get an advanced GDP number quarter on quarter at 2.6%. You know, the previous was negative. So the previous was in recession. But then the GDP data comes out and says, okay, we're not in recession anymore. It was that quick. So in a way, what are the Fed meant to do? You know, when the Fed is sort of like there reading the data, they're sort of like saying, well, we don't want to break things. And it's like, well, hold on a minute. Things don't appear to be getting broken because the jobs data is still pretty solid. The GDP data from last time out was really, really good. Even things like, you know, home sales and the new home sales number isn't as bad or isn't coming down as badly as people would have anticipated. So the leading indicators are, yes, they're showing weakness, but the pace of the weakness, I think, is the key. It's just not significant enough. So Jerome Powell kept with the same rhetoric.
I've got commentators, and you know, I don't listen to them intently, but every now and then I get into a podcast or something, and I've got a lot of economic commentators in the States saying that they've been in recession for ages, and that exactly what you're talking about, the figures may not be showing that.
Yeah.
Yet, if it feels like a recession and it looks like a recession, they're saying it's a recession.
Yeah.
I'm not sure how they actually get away with that, but
well, do you know,
you can only rely on the data, can't you?
Yes, you can, and that's another sort of thing about the Nasdaq, which makes me a bit kind of cautious about getting out here, but getting out in a way too early. I still wonder whether the Nasdaq needs to drop down to this pre-COVID high before we see some genuine buying going on, because the thing with that particular level is that if, as you say, the United States and other countries are in recession, but the numbers aren't showing it, what happens when the numbers do show it? What happens to these companies' profits? I mean, can they continue to pass on the inflation that they're feeling to their consumer and expect the consumer to consume? And I would have thought not. And this is the problem I find with the Nasdaq and stocks right now. If the FOMC are offering a rate of 4%, these companies need to beat that even before they are an attractive investment proposition. Because if they can't beat the 4%, then why would you put your money there and not just put your money into a bank account? You know, if your bank account is paying you 4% and you're speculating on the Nasdaq, actually, because many of these companies don't pay a dividend, you know, so some of the companies have got to show that they can grow. and you've got a potential for the environment not to grow because they put their prices up and consumers say, no more, we're not having that. So they don't have a chance to grow. There's no sort of R&D or anything that can go into these companies because they haven't got spare cash. And you've got companies that in this particular index that doesn't pay a dividend that beats the federal funds rate. Why would you put your money here? So the Nasdaq might actually not be might be the worst of the performers in this current climate, because they're not a business cycle. They're not quite as closely linked to the business cycle. They're not as closely linked to the recessionary aspect that the FTSE would be, for example, or the Dow Jones. So at least if you go to the Dow, at least if you take your money out of the Nasdaq and go to the S&P or the Dow or the Russell, maybe you're going to get a kickback. You're going to get a dividend. Whereas with the Nasdaq, you're not going to get anything. So as lovely as these companies look, that Tesla, Amazon, Microsoft, Apple, we know they're brilliant companies, but they're in a way they're the first things to go.
Because the discretionary purchases. Well, and most of those companies that you just mentioned, they're either discretionary or elite. In the case of Tesla,
yes,
it's more the elite, right?
Yes.
In the case of Apple, which is massive. In the case of Amazon, which is massive. In the case of Facebook, which is massive, or they're not having a good time at the moment. That's true. But all of those three big ones that I've just mentioned are discretionary income. Yeah. And if people have got lots of discretionary or excess, what do they call it? Can't remember. Disposable income. If you've got excess disposable income, they're the companies that do well, because you will subscribe to Netflix, you'll buy a new Apple iPhone, you'll buy stuff off Amazon if you've got disposable income. But the more that this inflation bites and the more higher the interest rates go, how can they rally on the back of that? They can't.
Exactly, because you'll make do. People have already got a car. It's not like it's the first car they're buying when they go into a showroom and go and buy a Tesla. Most people have already got a car, so they'll make do. They'll just fix it up a little bit this year and keep it for another year, because that's what you're hoping is that 12 months down the road you won't need to change anything. You'll keep your Apple. If you're a big corporate, would you sort of say, well, you know what, our margins are going to get hit, so we've got decent systems here. Let's not change the system as we do every 3 years. We'll change it in every 4 years this year, or whatever it is. So there's going to be sort of certain technology companies that are going to get hit. And as you quite rightly say, Meta, which it seems to be the nail in the coffin for Facebook, but Meta, the margins are terrible. Those revenues have been awful. They've been really, really bad. So I don't know. You have to wonder whether there is a significant rally coming before things start to turn around. And it's difficult for me. I've got to be honest, mate, because I look at this chart and we're looking at a weekly and we're looking at a pretty solid bar that I got in at a fairly nice price on. And because I am a short-term position holder, there's a massive temptation for me to close this position. But then there's something else in the back of my head saying, you know what, that the fundamentals don't really match me closing this position right now. And as much as we do have a little bit of support here because of this weekly low on this bar, there is another one down here and maybe a bit lower. And okay, hands up, it's unlikely that I'm going to have the wherewithal to be able to hold it down to here, but I wonder whether at least holding it down to the low of this bar might be the area that I'm going to aim for in this particular run, and then look for a bounce and maybe get back in again. I don't know. I have to look at the economic situation, but the economic situation looks more difficult now, because even though, as we've seen, after many of the rate decisions, there's been a rally, the 4% that we're now sitting at makes that rally, I think, less likely. And if you look at the last one, it was the same. So the last FOMC meeting, we came down and we continue to come down. This one, we've so far come down. we may continue to come down, and I think it's because that terminal rate is just quite restrictive for these companies to grow now, and we could be looking at 5-6%. And we said it last year, mate, and I know I said it on Monday, but we said it last year. They get north of 3.5%, these companies are really going to struggle, and that's where we
Absolutely.
are. So I don't know whether it's the time to get out of the Nasdaq just yet. Now looking across,
it's a tough one because really, what has it bounced off this time? Has it bounced off a trend line? No. There's a horizontal level there, kinda, where it's come back and retested the previous low, I guess.
Yeah.
But I know what's in your head. You're drawing a trend line down from the second top and thinking, well, even if it goes to there, it's still in a bear trend.
Yes, absolutely right. Absolutely right. I mean, it did bounce off the monthly pivot. I mean, we're talking about the weeklies there, and there's the monthly pivot there, so it did come back up there and struggle. But actually, when you look at the daily, there was also a trend line here. So that was the initial thinking. I mean, to be honest, cool. I was in higher. I actually took a position, and then just before the FOMC, because it was in the money, I closed that position, and then the FOMC happened, and I listened to the speech, and I thought this still looks rubbish to me. So I did sell it off again. But maybe here, maybe that's going to be my target down there, somewhere around about 10.7. So another couple hundred pips, I think, to the downside on the Nasdaq is where I'll be more comfortable about closing the position and not being too frustrated if it continues. So yeah, that area looks pretty good. But I do think ultimately it's probably coming down there. But I think you're right. I think a meaningful rally would be better before aiming for that lower line, and that would bring us down to there. I was also in I was in a short on gold as well, but I did close that position, and the reason I closed that position is it was actually a hedge against a long for silver, and because of course silver started to boost to the upside, so it started to burn to the upside. Off the back of Chinese news that they might well be sort of looking at opening the economy back up again. So industrial metal, it's starting to do very, very well. So we saw the bounce. But then obviously after the FOMC, silver started to come down. And I thought, I'm going to have to close that position. And I had a choice of leaving the gold position open. But because it was kind of part of the same trade, I closed both of them. So yeah, took a little bit of profit out of those, out of both of those, but it just this is the thing about the dollar as well, isn't it? We've looked at the dollar in a number of times, and it does look like it might well get to that trend line as well before reversal or any chance of reversal. We've looked at this a number of times, and we both sort of effectively established that there is this possibility that this level is the resistance zone, but we also see this line here, and that would drag gold, silver, the Nasdaq, and the like all the way, down to the prior levels again. So, but what I find interesting, mate, is the euro, and the reason I find the euro interesting. In fact, just before we sort of finish on the other things, before we go to the euro, this was the trade of the week that we talked about on Monday, the Kiwi yen, which did see some upside, and what was said on Monday was the fundamentals match a rally, but why would you trade it up at these particular levels? And look what's happening. The technicals are starting to take charge here. And the Kiwi yen is starting to look, pretty weak. Now, that doesn't suggest to me that there's a short in the Kiwi yen because of what's happened with the BOJ. But it does suggest that trying to pick up a long at a better price is currently in play. And I'll probably leave this one alone now. I wouldn't be trading it. And, there's probably nobody in the show that reads the analysis. But my personal take on this is, while it's green, it's slightly in profit, and I'd be sort of coming out of this one because of the technical level. I mean, I did say actually on Monday I wouldn't even enter it. But back to the euro.
You've got
euro
a
to
nice
me,
range form there now, you know.
yeah, exactly. It does look like a pullback. The euro to me is of huge interest, I think, in this market. And the reason I find it very, very interesting is that the FOMC is 2%. It's got a 2% spread on the difference between their rate and what's happened in the ECB. The ECB were incredibly late to come to the party. Will they get to 4%? Well, firstly, will the Fed slow the rate of change? Probably. There's a high possibility that they will slow the rate of change. They've gone 75, 75, 75. We've not had an interest rate hiking cycle of this magnitude in history. So the chances
you're going to have people jumping off buildings if they go 0.75% again.
I think so, mate. I don't think they'll do it. I think there might be a 25 basis point rate hike. There might be a 50. I don't know. But the euro situation, the situation in the eurozone is that inflation sits at 10.7%. Now, there's no question that the eurozone is in much deeper problem, or it has a problem over the United States, because the United States, we've seen the jobs data, we see GDP, both of them relatively positive. The euro can't boast the same thing. So the anticipation is that the ECB can't go quite as far as the Fed. But will the spread be as wide as 2%? As 200 basis points? I would have thought not, because their CPI data and their inflation data is north of 10% and rising. This is the difference here. So I would suggest that the likes of the Bank of Canada, the RBNZ, the RBA, particularly those three, and the reason I picked those three is because they've already started to slow the rate of interest rate hikes, will be outpaced by what the ECB do next. And because the price of the euro versus many of these currencies, if we look at it against the Aussie, that looks like a buy signal right now. It's a higher low. That looks like a buy signal. The price of the euro is attractive because it's fallen so far, and you've got a buy signal on the weekly there. Against the CAD.
Yeah, I like that yesterday. Yesterday I set an order on that, but I canned it.
Same with the CAD. We got a buy signal here. We got a higher low. We've got this low balling here, higher low. So I'd be looking at some upside with the Euro CAD, upside with the Euro Aussie, and potentially upside with the Euro Kiwi as well. Same thing, higher low. We've pulled back to this level. This is a classic area that trend traders will be looking to get in on the pullback, and that's what we're seeing. This is the pullback. So if that holds there this week, then the Euro Kiwi to me looks like a buy. It looks like a buy against the Aussie. It looks like a buy against the CAD, and it's purely off the back of, I don't think the spread is going to remain as wide now between the ECB and the other central banks, because they have to go. They've got no choice, in my opinion. And they've said it. The rhetoric from them is the same as everybody else. We've got to get inflation under control. So,
okay. Do you think you can get ahead of that, or does you have to wait till they do?
I think you get ahead of it. I think the difference between getting ahead of the NASDAQ and gold and silver is that there's already evidence that there is a shift in the paradigm. And the shift to me is that the ECB, they had a bumper rate hike last time out, while the CAD, the BOC, the RBA and the RBNZ both diminished their hikes. So the evidence is already there. So I think you can get ahead of what happens next, because there's already evidence. There's already a potential trend that has started in the shift in the reaction of the respective central banks. But we haven't had that from the Fed.
Yeah, it's interesting. I'd like to go back. I won't do it now live, but I'd like to go back and have a look and see when RBNZ in particular, because they went early. Yeah, they went 0.5, I think. I can't quite remember. And what that did to Euro Kiwi at the time, for instance. So does it make that much difference is really what I'm trying to ascertain.
Yeah, no worries,
if it does, if it does, then Euro Kiwi would have been hammered every time the RBNZ raised their interest rates, and RBA raised their interest rates, and the BOC raised their interest rates.
Yes.
So I'd be totally on board with what you're saying if those do prove to be correct.
Okay, mate. Well, in that case, I will give you that
There's
data.
my homework.
You don't need to do it. I've
You
done it
can-
already. So I've got P and N. Let's have a look. Right.
I've got a funny feeling I should be doing something. I'm now the host of the show, because, and those who didn't know, Philippines have had a bad typhoon, and a lot of the facilitators that we use are based in the Philippines. So they've had big issues with their cars have been washed out and all the rest of it. I think they're flood bound and having lots of trouble. So my thoughts are with Marlon and Sam and all of our facilitators at the moment, hoping they're okay. But there's only a few people in the room, and I'm just wondering if I missed something, because that's unusual.
Yeah, I see what you mean. It is less than normal, isn't it?
I don't see any signs that there's waiting. And normally there comes up there's people waiting to get into the room. Anyway, I'll learn.
Okay. This is the first one.
Yep.
First one, RBNZ raised by 1%. Euro still at 0. Drop down. This is the second one here in April, and they raised by 0.5% at that particular point. The very next day, the euro don't raise at all. Then the RBNZ raised by 2% on the 25th of May, which is there. And the ECB don't raise again. RBNZ go again on the 13th of June. Which is there. And the ECB start their hiking cycle on the 21st of July. There. So with this first one, the spread is 1% between the two of them. They get down here, the spread is 1.5%. So by the time it gets down to this particular point, the spread between the RBNZ and the euro is 1.5%. Now, but when they get back up here again, it's in fact I should have marked it off with different colours. Let's put this one a different colour because this is when the euro started. But these are all the rate hikes of the RBNZ, and 13th of June was at 2.5%. Yeah, so it wasn't until here that the euro sort of like made it a 2% spread again. Now, what I find quite interesting about this one is that if you look at this here, then this is where this one here, sorry, this is where there was a 2% spread. And it wasn't until here that there was a 2% spread. So it's very, very close. You know, the prices are relatively close. But what's happened since then, of course, is that the euro started to rally. Now, it took another month or so before the euro did rally against the RBNZ. But the RBNZ went again on the 17th of August, which was there. But that was slower. That was slower than the previous. And then the euro hiked by 1.25%. So and that was on the 8th of September. So interestingly, with the euro, 8th of September is there. This is when they started to close the gap, because
okay.
the RBNZ raised by 0.5% here, where the ECB raised by 75 basis points here. So this first one was quite significant because the ECB didn't move at all, and of course it's not just as binary as the
no, it's not. I mean, that was coming over the waterfall at the same time.
Yeah.
Well,
there's two things. There's two notable things here. The first thing that the interest rate rises are at these particular levels, but also what was happening to inflation. So what we really need to know when we see this one, the RBNZ raise again, but the euro rallies. So why did this happen? And it's possible that what we saw between this period here, which I'll have a look actually, is the CPI data started to weaken in New Zealand, but strengthen in Europe, suggesting that they will have to start moving. So obviously speculators aren't going to go, oh, well, they've done that, so I'm going to do that. They're going to go, what happens next? What's the likelihood? But then if they continue to then speak and say, we're not raising, then of course it's going to start dipping again. But then they do start raising here. And really, apart from this little dip down here, that was it. You know, as soon as the euro, the ECB did raise and the RBNZ raised one last time, then the difference between these two levels, I think, was probably the significant thing, which did actually, I mean, that was the low. The last time they raised, that was the low. Then we get bumper hike and things changing on the RBNZ. So, the central banks end up, generally speaking, in around about the same place. So that would suggest that the euro is probably going to 3.5% at some point over the next year, and the RBNZ is unlikely to go beyond 4%. So they'll end up sort of like, pretty much in lockstep. And it's been a fantastic year, really, because the central banks have moved at different rates. But what we now get is the opportunity to suggest that they will eventually move back in sync again. And if that does happen, and that it's pure speculation, but if you do speculate on the fact that they will do that, and if you look at the CPI evidence, there is suggestion that should happen as well, because the inflation data in New Zealand is coming down very gently, whereas in Europe it's still going up. So there is suggestion of that. That tells us that the ECB are likely to move closer. And if they move closer, and what we have currently if what we have currently being priced in is a 150 basis point spread, then as that shrinks, then 150 basis point spread. As that shrinks, then the price of the euro should go up against the RBA against the Kiwi.
And this is where I find it really fascinating at the moment, because I'm not seeing that. I know you are technically, but I'm not seeing it technically. If you go to the weekly chart, I'll show you what I'm seeing. Well, actually, before you do,
yeah.
I can see the horizontal level that we're currently at, which suggests a buy zone. I get that.
Yeah.
There, that makes sense as a buy zone.
Yes, it does.
But if you were to draw a line down the middle of that chart, you can see what happened on the left has happened on the right as well. So the line of symmetry is pretty much perfect. So it suggests to me that cycle has ended. So we're going into a new cycle. What that cycle means, as yet, I don't know. But if you go to the weekly chart.
I mean, the other thing about this, mate, as well, the other thing that I find, quite interesting, this is obviously the dailies. Now, if we do change this to a weekly, look what we've got on the weekly, and you may well be seeing something different to this, and you probably know what I'm going to point out. But this is an inverted head and shoulders, and it would suggest that there's probably a little bit longer before this right shoulder plays out, but we are at the low end of that right shoulder. Lower end of the right shoulder.
All right, let me show you what I see.
Okay.
If you go to 14th of Feb, roughly. What's 14th of Feb?
On the weekly?
It's Valentine's Day, right?
Yeah.
On the weekly, yes. And draw a trend line from the highs, just go straight through the highs from the 14th of Feb up to No, a trend line, mate. Sorry.
Yeah.
14th Feb 2021.
14th of Feb 2021. Okay, that's back here. This one here.
Yep. So start your trend line there, and
Yep.
draw it. No, on the top. Sorry, on the top of there. So go up to a high. Any high, doesn't matter.
Oh, okay.
No, come down a bit. Where have I got my high? Sorry, I'll tell you where I've got my high. It's on the 17th of January. The high on the 17th of January.
Yeah, got it.
Swing that up to the last high on the chart.
This one up here.
Yep.
Yeah.
There. And now swing one down from the low on the 21st of February.
Down to the low. Oh, so from here. Like that.
Now go right down to the low. So the first low after that. After we've started the trend line.
Oh, I see. Yeah.
Yep. Swing that through the next low. And that's my market structure, which is telling me, okay, we're at a buy zone right now, and I get that. But overall, I'm seeing that broadening pattern as continuing, and I see it back down around the 157 mark.
Interesting, mate. And let's have a look at this as well, because this looks. What's quite interesting about this, and it's difficult to kind of see, but certainly from this particular period here, this level looks like the mean. You know, it's tested from above.
Yep, yeah, it does. Yep.
You know, and it comes down and it sort of like stays below it, then it goes slightly above it, takes off a little bit, but then it kind of finds that it seems to find this level. It likes this level. Now that does suggest kind of taking off crazy would be unlikely, but it does also suggest looking at this, and I really like this trend line. Looking at that, there might be one more shout to try and get up there, especially if this inverted head and shoulders is in play.
I agree. I think it's a buy right now, where it was a sell at the beginning of the week. But I think it's only a short-term buy until we get that lower high, and that's what I'll be looking for. If I get a lower high there, I'll be a seller.
Yeah, I think this one will be a really interesting case study in many ways, mate, because of the differential between the interest rates and seeing how things unfold over the year. I don't know if you'll remember this one, but I think we should maybe mark it down as one to discuss in kind of future weeks, because it's going to take a little while for this to play out, and interesting to really see sort of as the data unfolds, how is this affected. Now I can tell you as well that I did note down the CPI datas for what we were for both the. Actually, let me just mark off this here, and so I can see it a bit easier.
Post Halloween blues, Paul P. Is that the lack of attendees today? Is that what you mean? I don't know where they are, but got no idea.
CPI in New Zealand at 7.2% from 7.3. I mean, it's small, but since 18th of July, the CPI data, 18th of July went from 6.9 on the 20th of April, and 6.9 on the 20th of April, which is there, which again preceded a rally. Now, what was it previous to that? 5.9. So it had jumped quite significantly. But the euro had jumped 7.4. So now this is interesting. So what we got right now is 20th of April 2022. Euro CPI data year on year 7.4%. Kiwi CPI data 6.9%. So a 0.5% spread there. Then if we go up to the next one, next sort of like one where they're both reporting, should have more CPI data than that. By the time we get to the 18th of July, Euro CPI 8.6%, Kiwi CPI 7.3%. So it hadn't really moved significantly by July. What was that? July the 15th. Which is there. So not a big movement, but the euro had started to come down. But now we're talking about a 1.3% difference between the two. Euro continues to creep up, and we see the next CPI print from New Zealand at 7.2, so coming down, whereas in euro it was at 10%, and that was 18th of October. So a lot of the moves are done. Now, the thing to note here is that market participants are able, or I mean, we're all able to, but they are fishing out all the data that suggests what's going to happen to CPI, to new home sales, to unemployment. So they're looking at the data even previous to what we're looking at. We're just looking at the actual consequential print. But they're looking at the suggestive numbers to give them an idea of what those numbers are. So when you do see a rally like this, and even though it might not be off the back of a rate statement, the assumption already is in play that inflation will be doing this, and particularly if unemployment numbers are looking a certain way, then the unemployment numbers will be doing something else. So. So I think there's quite a lot of things to kind of take into account here.
There always are, of course.
Yeah,
it's very, very difficult to just pin one thing and say, okay, I'm going to hang my hat on that. So
yeah,
here we go. And that's why we trade at 1% risk rather than 15% risk, right? Or 50%
absolutely right.
Risk.
Yeah,
Because we don't know at the end of the day. There are other forces in play. And I guess the more forces you've got at your disposal, then obviously the more you can load up on that.
Yeah.
I'll be very interested to see how this pans out, actually, given what we've just discussed for the last half hour or so. And I'm sorry if that's been boring to guys, but to me it's fascinating, because to actually get all of those things working at the same time and come up with the result is exactly where we need to be, right? That's what we need to do.
I mean, this is where the what I'm really interested in is a system where the technicals match what the assumed fundamental picture is saying. Because if they do, and you've already got a really tight technical strategy, then you'd assume that with getting better at sort of reading the fundamentals, that actually you get rid of some of those losers. Because
my point entirely, yes.
Yeah. So I think it is fascinating, but that would be the way that I would read the data right now. The way that I would personally sort of like be looking at this data is suggesting to me that the ECB are the next to move, and they're much more likely to move than the BOC, the RBA, and the RBNZ. Probably as well the Fed as well. To be fair. The Fed's so far away that that the suggestion would be that they would start to weaken, but the difference really is that they haven't yet done the move where the previous three have.
Well, that was the question, wasn't it? Whether they would or whether they wouldn't.
Yeah,
and they didn't. So, what was the tone? I think you mentioned it earlier, but I must have been doing something else, like trying to find people who weren't in the room. What was the upshot of the statement? Was it bullish, dovish, hawkish?
It was well. Do you know the big takeaway, which I thought was pretty hawkish, was when he said the federal funds rate will probably go higher than people expect. The rate may slow down. So we might get a 25%, a 0.25% rate hike next time. But there's likely to be more of those particular rate hikes. So the rate might slow down, but the likelihood that it goes beyond 5%, north of 5%, I mean, he suggested it's pretty high. I mean, we could be looking at a federal funds rate of 5 to 7%. Sorry, yeah, between 5 and 7% over the course of the 12 months.
Lowe was the same. He was not saying that this is the end by any stretch of the imagination.
Yeah.
In fact, fasten your seatbelts.
Fasten your seatbelts, mate. You can't survive, without getting these interest rate higher with inflation at 10%. It's just not possible. And this is where the relief that the market will find will come from a resumption of peace in Europe, and maybe some supply sort of issues, but it is that the supply issues were exacerbated anyway because of COVID. So, and COVID is still kind of like a bit of a problem, particularly in China. So there's
new strains here now,
right? So there's things that need to be ironed out. I mean, as I say, the paradigm, there's been a paradigm shift, and I wonder, while we're looking for these markets to start to rally, that the rally, we're in a bear market. We are basically sort of in a bear market when it comes down to indices. That is, when it comes down to these currencies, there may well be a 4 to 5 years where it's really, really good for traders because the central banks are doing something different. For so long, they're all at zero, and they stayed there. That there wasn't quite as much movement in the markets, but now we are starting to see things change.
It's certainly there. It's a little bit choppy, I've got to say.
It's a bit choppy as well, but
it's certainly there.
But look at the difference. Look at the difference with 2021, that area there, and how tight that consolidation was to what we've had, just these wild moves, really kind of going up and down, but still respecting levels. There's still horizontal levels along here. Not a problem, really.
Yeah, that's the beauty of a technical chart. Absolutely. Yeah. They still do. The fundamentals may drive it in that direction, but once it gets there, away she goes.
Exactly.
Are we done?
We're done, mate. Yeah, we're end of the week, end of the hour. So
that was a good exercise. I didn't mind that. I liked it.
Yeah. Well, we'll discuss it further, mate. I'm doing sort of like a little bit more of this research right now, just to kind of get an assumption of where central banks are going, and if you can make a judgment call on GDP, and you can make an assumption call on a central bank's next move, then you're in pretty good shape of where the direction of a currency and an index is going.
Yeah, and then, as you say, if you happen to be at support or resistance, and that coincides with that, happy days.
Yeah,
indeed.
Exactly.
Any takeaways to look forward to for the next 24 hours, mate, or what?
Well, there is some further data from the United States, and I guess the big takeaway is that this market.
Well, we get the BOE shortly, right?
We've got the BOE that are likely to raise interest rates as well. They're likely to hike and go. The United States average hourly earnings are going to be of interest. Unemployment rate again going to be of interest. So everything is going to be swallowed up, mate. Any little piece of data is now going to be swallowed up as a point of interest for these next market moves.
Yep. Look, the only thing that I really want to add is that once again we've got an untested daily pivot and monthly pivot sandwiched together on the euro dollar, and as I said from the outset, I believe there will be a considered opinion from traders going into, I thought we may already have seen it, but we haven't, going into this session and into US session, maybe even, that we'll have some response from the buyers or the sellers, sorry, for the dollar. And therefore, I think euro dollar, if it does set up for me, I'll be looking to trade it to the daily pivot. But that's it. No further. I'm not suggesting that it's going. I'm not bullish on it, but I'd like to pick that up to the daily pivot if possible.
Brilliant.
That's kind of where I'm at, mate. It'll be the same for the pound. It'll be the same for the Aussie. It'll be the same for the Kiwi. It'll be the same for the CAD, upside down. So,
yeah. Just a quick question from Paul P about the what does the 900 mean? And it's telling you so here you go here. So that what this relates to is the members, and it's quite significant. So if you get 9, that tells you that all 9 members voted to raise or lower the rate. So they're anticipating all of them to vote in the same way, effectively, and that's quite a strong signal. And you don't always see that. You know, there are sometimes you'll see some members that don't vote in the same way. So if you kind of go back to the,
it's actually really interesting, Ash, when that does happen. In particular, when you're in a case of, okay, will they go? Won't they go? And the month before, you see like a split decision, yet they hold. You can almost put your, no, won't say left testicle, on, if it is a split decision, then the next one will be a raise.
Yes. Yeah, I mean it's interesting sort of how these dynamics do work. In fact, that was they all voted the same way that time. So they're telling you that all 9 members of the MPC voted for the same rate hike, and some of them will vote for. In fact, they're pretty in sync on the BOE, but by the looks of things. Oh, here you go. Here's a different one here. So in fact, there was an assumption that there would be a descender. So somebody kind of like doing something different, and it's kind of telling you whether somebody thought that they should have raised higher or they should have raised lower, but they ended up all voting in the same way as well. So that's what it's telling you, and when it's solid, it just means that there's harmony in the bank. But you do see that they don't really fall out over it, but you do occasionally see the numbers go 4-4-1. You know, so stuff like that can happen.
Yep.
No problem, Paul. No problem at all.
Not at the moment. At the moment, everyone's on the same page, unfortunately.
Yeah, they've got a choice. Yeah.
Yeah. Their hands are tied. It's as simple as
Let's
that.
wrap it up, and we'll be
all
back
right, buddy.
Monday.
Good luck with that NASDAQ, mate. I hope it keeps going for you.
Yeah, well, do you know, as I say, mate, have I got the wherewithal to not take the profit? It's quite a nice bit of cash in the house.
Yeah,
I might well close it up. I'll see. So yeah, we'll see what I did on Monday. No doubt it'll be closed.
Happy days. Okay, very small crew in today, but thank you as always for being here, and we'll do it all again on Monday. Well, I can't really thank Sam or Marlon because, as I said, they're having their troubles over there in the Philippines at the moment. Mate, thanks for being me trading buddy, and thank you guys for being our trading buddies, and we look very much forward to seeing you next week on Monday. Have a great weekend. Bye-bye for now. See ya.
Bye, guys.
I've got to do